Hello, YouTubers, friends, compatriots, bootlickers, shills, dustlights, hearts, peasants, vassals, minions. Did I forget anybody? I don't think so. I'm a useful idiot. Welcome. And, well, I got some bad news today, but I guess that's what I do. And this new report seems to purport that the housing bubble, the reinflation, is bursting, is either bursting or about to burst. And that's because after 40 consecutive months of foreclosure declines, we now have a large surge, and that trend is reversing. So that's something to perk our ears up about, particularly when you get into the numbers and see that specific markets are particularly skyrocketing. So what we have is that monthly foreclosure filings, including default notices, scheduled auctions, and bank repossessions, reversed recently and increased by 8% in December. And then they increased by another 13% in January compared to December. And so that's a pretty huge surge. And then if you take it by individual markets, it's even more shocking. Maryland's up 126%, Connecticut's up 82%, New Jersey's up 80%, California's up 60%. So those are huge surges in foreclosures in those markets. And there's a large backlog of distressed inventory, 90-day delinquent, 3 to 6 million or more. And that's a huge number. And the number varies widely because the banks don't really want to use the real numbers. And in fact, it says 32% of seriously delinquent borrowers haven't made a payment in 4 years, and that's up from 7% in 2012. So this huge backlog of delinquent, 90-day delinquent payers, 3 to 6 million or more, 32% of them now haven't made a payment in 4 years. So what does that tell you about banks keeping these properties both off the market and not having to adjust their balance sheets for these delinquent properties? And estimates are that the shadow inventory is actually 4 times what the official stated inventory is. And the article that I'm referencing, I'll attach below, it uses one example of one county in New York where the numbers were off by that much. So if we take the somewhat official figures of somewhere between 3 and 6 million delinquent properties and times that times 4, the actual shadow inventory, then we have a lot bigger numbers, somewhere between 12 and 20 million homes off the market and delinquent, potentially could hit the market. And so we know there's a lot of deflationary pressures going on, and now we see this jump in foreclosures. And does that mean that the new price, the reinflated price of the real estate market, propped up by the Federal Reserve, is now peaking? And those prices could be reversing. And if that happens, then, of course, a lot of the institutional investors will probably liquidate their portfolios. And that's exactly what we're seeing. There's 2 things that boost this idea. One is the housing market growth of the last 2 years wasn't propped up by higher wages. It wasn't propped up by lower unemployment. It wasn't propped up by consumer confidence. It wasn't propped up by credit expansion. It wasn't propped up by pent-up demand. What it was propped up by was 4 things. One was Federal Reserve policy, and certainly buying up mortgage-backed securities is part of that. Number 2 is inventory suppression, which we have, like I say, this gigantic shadow inventory. Number 3 is ineffective government programs, and all these programs that the Obama administration have introduced have failed and have only helped to hide further deterioration in the market. And then 4, the big one, speculation. That's where we have all these large institutional investors that have single-handedly almost driven a lot of these huge markets and these huge price increases in those markets. And so since that reinflation was artificial, created by these market distortions by institutional investors and the Federal Reserve, we have these deflationary pressures in place once again. And it doesn't matter that the Fed has purchased $1 trillion mortgage-backed securities over the last 4 or 5 years and continue to buy them And so we end up with a lot of these same dangers that we've had in this market before. So anyway, let's get back to this. We have this swelling of foreclosures and this turning point. And like I say, institutional investors, the majority of real estate experts now think large-scale investors will begin unloading their portfolios over the next year and several years. And this seems like a likely prediction. So a short-lived romance between the large equity funds and the real estate market, although they're still operating on a global scale. So we have prices retreating in the United States. We have tapering, of course, will affect this. And then these rental-backed securities that were they tried to sell didn't fly too well. And so since that market didn't respond, there's no reason for the institutional investors to stay into real estate in the long run. So we'll have an uptick in foreclosures, we have a huge shadow inventory, and then we have institutional investors unloading the portfolios that they've bought up over these last couple of years, which is substantial. I'll attach my video about the the fake real estate recovery because of institutional investors. I'll attach that below. So if all of them end up dumping these properties, we're going to have a repeat of a real estate bubble collapsing. Home sales are down, home sales applications are down, and home ownership is at the lowest level in 20 years. And we're not going to see this this growth amongst up-and-coming middle class. 2013 annual household growth lowest since 2008. So where are these first-time home buyers going to come to fill this 48% gap in the market? Most of these college kids are coming out. We've got $1 trillion in student loan debt, and they're moving back in with their parents. They will not be buying homes, and so we'll see a ripple effect because once again we have a new wave of subprime loans, home loans that have been created over the last several years. A lot of them by the same bad actors that were involved in this in the last one, and then we also have mortgage-backed securities continuing to deteriorate because of this. And this is alarming, like I say, because we still have mortgage-backed securities being created. It's one of the main reasons why the big players are interested in the real estate market. And the Fed has purchased $1 trillion in these mortgage-backed securities. So not only are these assets deteriorating on the Federal Reserve's books, but they're also continue to deteriorate in the bank books. And as I pointed out earlier, also, if the shadow inventory is actually somewhere between 12 and 20 million, and we have all these deteriorating assets, and this new real estate bubble bursts, then once again, all these banks are broke. All of them are insolvent. Everything connected with these real estate investments and all the securities and all the derivatives involved in the real estate market, will create another cavalcade effect. And it's pretty safe to say, too, right now that the new housing bubble's peaked, especially, like I say, if we see this reversal, then it's clear that this is the peak of the new housing reinflation. And certainly with tapering going on, this will only exacerbate that situation. So anyway, kind of looks like the new reinflated housing bubble may be bursting. So let's keep an eye on this and hope for the best, along with everything else. I'm a useful idiot. Don't you be one too.